All right, everybody, welcome back. Sorry, I made a thumbnail, which is unlike me, and just wanted to hang out with you guys. So there's no Palantir Weekly this week, and so it gives me the opportunity to kind of hang out with you guys, answer some questions if there are any, and just see how everybody's doing and what we're up to. Just me, you guys, and the good old Houston City skyline / green screen. But yeah, things are going well. Portfolio is doing well. The rental properties are doing well. And so with that, I think with the week in the year that we've had, I think overall things are kind of going in the right direction. And so wanted to take an opportunity to kind of hang out with you guys late night, drink some bourbon. In this case, we have I think it's a Caribbean cask, single malt Scotch whiskey. So we'll just drink a little bit of that and hang out, answer any questions you guys have. And it's been a while since I've been able to hang out with you guys one-on-one. I most of the time am doing something on a Mitch channel or doing something that's completely unrelated, kind of just off the cuff, making videos and stuff of the like. And sometimes I just lose a little bit of that touch that, getting in touch with you guys and answering your guys' questions is sometimes the most important thing, because at the end of the day, we all do what we do, or the majority of us do what we do on YouTube for you guys and answer your guys' questions and to see what's pertinent in the minds of the folks that are here to support us on every single week, night in, night out. And so it really, I don't want to say it bothers me, but like it always, when I see questions in the chat and like, when we're on Palantir Weekly and stuff of the like, I always like to converse with the I don't want to say co-stars, co-hosts that are on there. And at the end of the day, we're there for you guys. And I think sometimes you guys bring up some phenomenal points, and unfortunately, it gets missed. So, but who knows? I mean, this is going to be free. I don't really have any agenda other than just hanging out with you guys. And so if anybody wants to join up and hang out, just let me know, and I'll be more than happy to put a link in the description. But otherwise, let's just hang out, man, and talk. The Airbnb house is doing really, really well, man. I don't want to give too much specifics, but for the month of April, I'll bring up my spreadsheet in the background, but for the month of April, it did pretty well. I'm not sure if or I guess we're in April. So last month we had 32% occupancy. We rented out $2,850, which wasn't enough to meet the mortgage, but it's off season, so not too upset about that. For the month of April, we're looking really good. We have about $5,100 in rental, so that more than covers. And then obviously we have some cleaning fees and stuff like that, but all those expenses more than covers the mortgage and everything, which is good because April's an off-season month. And then May, we're looking light on May so far, which is pretty interesting. So we have like 22% occupancy for the month of May, which is interesting because April has 50%. So I'm hoping we fill up May a good bit, but we still have about $3,000 in rental income. So at the moment, May is looking like it's probably, just without any further bookings, break even-ish. But that's, like I said, we're only at 22% occupied. So hopefully once we get a little bit into it, then for like June, July, August, September, those are looking healthy. So June's 80% booked, July's 90% booked, August is 73% booked, September's 56% booked. And so that's where the cream comes in, right? That's what we're hoping. And altogether, that's looking, it's like $38K worth of revenue. And so that alone, kind of covers the mortgage for the year. So it looks really good in that respect. But of course, you have to pay the cleaners, you have to pay for electricity, cable, one-time items. And so with that, we're really hoping, kind of end the year at about a 24-ish, 25-ish%. And like I said, that's current bookings to date. That's not including if, we get additional bookings throughout the year. Currently, we don't have any bookings for November, December. So if we get a weekend here, weekend there, that'll hopefully bring us up. My goal is for cash on cash, not including equity build, is like 30%. And so I just think we walked into something that, like, I wouldn't expect. I'll just be blunt. Like, I ran some numbers for some of the other properties that are nearby, and I just think we walked into the right property at the right time. And the guy that was running it before was doing an absolute phenomenal job with it. And so I don't think I could be able to replicate this. And if we put more money down, we definitely wouldn't be able to replicate that. Like, we didn't put down 20% because it's a secondary home. The person that I am partnered with in it goes down pretty regularly. And so we only put down 10%, but any future properties, we'd have to put down 20 to 25%, depending on who we use as the mortgage broker. So because of that, any returns that we get are going to be amplified just because we only put down 10%. So, but either way, like, a really good opportunity that we're lucky we found. So we're at like 40% occupancy for the year. January was pretty slow because we just picked up the property in December. So obviously coming in, getting everything up to speed on Airbnb, VRBO, that took a little bit of time, but cautiously good. I mean, if I'm happy if we get up above, like, it looks like the target to kind of break evens like 32%. And we're at 40%. And I'm really hoping we get closer to 50%. That would make me ecstatic. But at 50%, man, like, the amount of cash they're going to be generating is pretty astonishing. So I'm really looking forward to how the property matures with age. But hopping into the SPY shares, right, covered calls as much as I can. I try not to when the price is super down. And because basically what I'm trying to avoid is when the market kind of pulls back significantly, you always have these peaks and troughs, right? So if you're a swing trader, you know what I'm kind of talking about. But every month or so, there's going to be this in and out. There's going to be the flux of capital coming in and out, news coming in and out, where you have these local lows and local highs. And so I try not to write covered calls on the local lows, right? I'm always focusing on the local highs of writing those because, one, you're going to be able to be more secure, right? So it's more likely when you kind of have those local highs that the price is going to retrace and it's going to keep going forward. Not to say that it won't continue to go up, but for example, we're kind of on a local high. Let's just do some Google Finance SPY stock. Where can I get Google Finance? Let me just pull it up here. I just do comparison. Yeah, compare, and then it brings up. Yeah. Zoom a little bit and make sure I don't have anything crazy shared. Nope. Okay, so then present, share screen. And we are going to share this guy. So you can kind of see, so we have SPY on the top, which is in the blue. What I like to look at specifically is like these local peaks and troughs. So I won't write covered calls when you're kind of down at this below, but I'll write covered calls when we're kind of getting to this. And I'll generally do weeklies, but sometimes it works, sometimes it doesn't. And so even within here, like if you look in the 3 months, you'll see these little peaks and troughs of like local highs and local lows. So it's like you have these monthly peaks and troughs and you have these weekly peaks and troughs. And so if you wait for a couple good up days, then it's better to write the covered calls, get a little bit more premium, and it's a little bit more secure because it's more likely that you're going to have a pullback in the next day or so. I mean, yes, you can have 9 up days in a row, but it's rather, kind of unlikely. And so having that kind of helps you with understanding, and getting that covered call income. So I love that. And, it's not a lot of money, right? But when you add it up, it can be on the order of, $30 here, $20 there. And so when you do that 50 times a year, you're looking at $1,000 or $1,800 in some cases. And so when you're talking about $100,000, $130,000 invested, it's an additional 1%. And so a lot of people might be out there and say, well, crap, the SPY is only yielding 1.5% or 1.6%. Well, then here you go, writing another 1% in covered calls. Yes, it's active, and I know it's not passive, what have you, but that immediately increases it from 1.5 to 2 to 2.5%. You're looking at something that is a little bit more tangible about, keeping it in something like a SPY where you have more of a long-term growth look aspect to it and getting that income kind of coming through as well. And it also helps offset because like VOO, let me dim this down a little bit, like VOO and IVV, they don't have nearly the liquidity in an options perspective as SPY does. And so that's why I choose SPY. A lot of people always ask, like, why SPY? Why SPY? The expense ratio is higher. It's like, okay, 0.09% versus like a 0.02 or 0.03. So anyway, so Eugene, what's going on, man? Hope to meet up again here soon. I know that I saw like a couple months ago you started making videos again, so hopefully continue to do well. But otherwise, we should hang out and do another live stream or video at some point. What do you think of the people who advocate for VT only focus, your time on other things? It might make sense with your new interest in vacation rentals. So I like VT, but to me, the thing I dislike about VT is international stocks are positive and negative, right? Like, I just don't think that I don't think there's a lot of other business environments out there like the United States. There's a reason why, as much as we might complain about how, things are turning out, the US is turning to garbage, whatever. In terms of a global perspective, there's still a lot of opportunity in ease of doing business in the United States. And so I'd much rather personally, I mean, I know it's a big gamble because of course, like currency impacts and stuff of the like, because, who the hell knows that the US dollar is going to hold on forever. But at the end of the day, I'm just a bigger fan of just the S&P 500. I can see myself doing like a ITOT, which is the total stock market index, which is like 3,600 stocks, which includes some micro caps, small caps, or what have you. But VT, I don't know. You're investing a lot into Europe, and Europe, I don't really see as a very growth market here personally. So how many business development companies do I own? I used to own Main Street Capital, and I no longer own that. I forget what I sold it at, but it was a couple of years ago. And I think where my thought was, I want to say it was like late 2020 or early 2021. But my thought was great dividend, but I didn't see a lot of the growth kind of coming forward in it. And so I want to say I sold it in like the low 40s. Where's my StreamYard? Here it is. So I want to say I sold it in the low 40s, and that's kind of where I sold it at. I bought some. I think I was buying some in 2020 because the dividend was still good, and I was, hoping it would turn around. And once it kind of got to the low 40s, I was like, it's probably going to hang out here for a while because at that point it already kind of peaked before 2020. And, I forget where I put that money into, but did okay with it. I think it's a decent company if you're looking for a yield. But for me, most of the time lately, I'm more so focusing on just investing in the long term. Hak Amit, thank you for joining. Hope you're doing well. Hope to see you next week. We talked ABML. I did not, man, and I appreciate that. I need to write this one down because the market's been on somewhat of a positive footing. a lot of you guys that have followed me, I do some of the conversations with CEOs and stuff in 2020 that kind of calmed down drastically in 2022 due to the market conditions. And now that we're kind of having a stabilized footing here into 2023, I've actually gotten some reached out. I did an interview yesterday with a nice gentleman from a gold company, and focused specifically on, well, I guess you'll just have to wait next week, but basically focusing on South America and the last frontier of kind of mining there. And he reached out a couple hours later and said, "Hey, I want to do another one for a different company that he works with." So, but anyway, I think that maybe I should reach out to those guys. That could be a good opportunity. And I've seen ABML show up a few times, but I apologize. I haven't reached out. And I think the reason why I never reached out before is because everybody that I did reach out to was kind of shutting it down because 2022 was not doing so hot. Of course I remember, brother. Of course I remember working with you. And, I'm curious. I haven't checked up on your other channels as well. Hopefully those are still doing really, really well. But, the hope is, I remember everybody I work with, man. It's part of the reason why I'm in the business. Like if I was strictly in this for the money, I would have quit a long time ago. I only have 10,600 subscribers. I've been doing this since, I don't know, 2017 or something like that. So if I was in it for the money, I'd be, I'm more in it to learn. I'm more in it to meet with great people. And with that, there comes the peaks and troughs of that, right? I mean, unfortunately, I met Amit here, who I've been doing a lot of work with lately. But, people come and go, whether or not they, whether it's stabbing in the back or whether they just, stop doing the YouTube thing or they retire and they just kind of look into being ease in their life or what have you. I try to remember everybody that I work with. So, but yeah, would love to work further together. But yeah, I need to get a better background. Like I need to get like, yeah. And the background changed obviously when I talked to you last, Eugene, because last time I think I talked to you, I was still in Trinidad. So that was probably almost 3 years ago. Because I moved back to the States in September of 2020, late September 2020, October 2020. And so I think when you and I chatted, I don't know if the pandemic had gone on yet, but it was when I was just first started getting involved. Yeah, crazy. I don't forget, man. At the moment, I'm making a program called Creator Head Start about creating large-scale YouTube channels without showing your face if you need content. Yeah, man, maybe I should have a chat with you. Amit, maybe we should chat with Eugene. Eugene's got a lot of experience. His channel that he's talking on right now doesn't have a lot. Sorry if I'm blowing up your spot, Eugene. But this guy's got some YouTube channels, like just like he's describing, where he doesn't have his face being shown. And it's like more quality and stuff of the like. And so I need to get more lessons from this guy. And I'd happily pay you. And like I said, it's not necessarily about the money per se, but it's more about what I can learn and do better, because at the end of the day, I'm just trying to help people in any sort of way I can. But glad you're getting properties. Like I struggle with this right now because I live in this apartment and I pay, more than I should in rent. But at the end of the day, I'm like, is it worth it for me to buy a personal residence? Do I buy more rentals? Do I buy a vacation rental? Because like the beach rental that I have is in New Jersey, and that's kind of where I grew up. I didn't grow up in Jersey. I grew up in Pennsylvania, but the beaches that I used to go to were in New Jersey. And there's beaches here in Texas where I live. And I'm like, should I buy some in Galveston? Like, I'm just trying to think about it. But yeah, I'd love to chat with you about that as well. Have I talked to Dave? Yeah, I talked to Dave briefly, not a lot. Mostly what Dave and I talked about. So I wasn't talking about Dave. I did when I not the backstabbing. I wasn't talking about Dave. For Dave, it was more the retirement piece. I think he's just gathering his bearings. It has been close to a year since I've like had a full on conversation with the guy though. Like I've exchanged some Instagram messages with him to make sure he was okay. I followed his journey on Hidden Off Grid. So let me pull that up as well, because that would be For those of you guys that don't know Dave has a really good story. Dave did really, really well as working in software and stuff of the like. And so he had a relatively successful YouTube channel. Lower success, I'd say, not amazing, but he decided he's like in his low to mid 40s. It was time for him to just call it up. He had acquired about $2 to $2.5 million and wanted to just say, you know what, I just need a month off, or sorry, a couple months off. And what he did is he created a secondary channel and hiked the Appalachian Trail for a couple months. And so the background of Dave, he was a really good YouTuber. I collaborated with him quite a bit. And he was creating YouTube channel material about dividend investing, about options writing, and he would have a weekly chats, just like I'm kind of doing on Sundays. He would have a weekly chat with my other buddy, Retire with Less. So GW is a good friend of the channel as well. And so with that, they'd kind of go back and forth and had a good camaraderie. And when Dave kind of went on his hike, he hasn't really returned back to YouTube as of yet. And so I'd recommend just going take a look at some of Dave's material. He does a pretty good job talking through his portfolio. It's pretty impressive as somebody in their 40s, what they've been able to acquire. And I hope, to get to the same as Dave here, within that amount of time. And also check out my buddy GW, who does, covered calls. He does cash secured puts as well. And he's a good friend of the channel. And so they all kind of have their own niche and do really well. But they used to have a really good program working together. And Dave, unfortunately, because of that retirement, he's kind of kicking it up. But it reminds me, man, maybe I give him a call tomorrow and see when the next time I can get him on the channel is. But Dave's a good friend, man, and I miss talking to him pretty regularly. So, but I'm more so here for you guys, man. I mean, there's only 20 of you guys in here. I'm not having to focus on Palantir. I'm not having to focus on any particular company. I'm really here to just chat with you guys and figure out what's on your guys' mind. And I need to do these more regularly and kind of bring back what I used to do, which is, fortunately, Palantir Weekly being paused this week on Amit's channel allowed me to kind of get this. And I was waiting for SoFi Weekly to end just because I don't want to compete with anybody. And not for my sake. I just don't want to take away from other people's sunshine. As much as crap as I give some of those folks that are co-hosts on SoFi Weekly, I don't want to step on anyone's toes, and I want everyone to be successful here on YouTube. So, so specifically about SoFi, I fell out of the game with SoFi. It's not that I'm bearish or anything of the like. I had SoFi back when it was one of the social capital SPACs, and then it kind of got announced, and I was able to benefit off of that announcement. And I sold, I want to say, somewhere in the 20s, and so I made okay money off of it because I bought before it was announced as, like, I just bought the SPAC, pre-announcement, so it was at $10 when I bought it, and then it merged and did really well. And I wrote some covered calls and stuff like that, and made money off of that as well. But I only had 100 shares, so it wasn't like a lot of money. It was bets, like it was small bets. So $1,000 here, $1,000 there in different social capital funds. But they do for those of you guys that aren't aware, my buddy Amit, he, generally speaking, not this week because he's all away on business, but him on his channel, he does a SoFi Weekly. And Amit, I'm just gonna shout you out here and put your channel in here. And eventually I need to give you a wrench as well, because I don't really do so much streaming on here. I don't really have all the wrenches and stuff handed out. So apologies for those of you guys that are like, I don't have a wrench. It's like, I'm sorry. I don't really stream on here as much as I should, but I recommend you guys, really go check out Amit's channel. That's where we do a lot of the Palantir Weekly. That's where we do he does a lot of SoFi Weekly as well. I'm not on SoFi Weekly, but he does a really good job working with folks that are very knowledgeable about the organization and stuff of the like. So Palantir, man, I'm more than happy to talk about Palantir. I'm not a very technical person. You can kind of hear that when I talk about it on Palantir Weekly, but I do use the software every day. Like I literally had it open about an hour and a half ago, looking at some of our wells to see if they were opened or not. And you have to think, like, I work deep water Gulf of Mexico for a super major oil and gas company, and so just looking to see whether or not that well is open or not. It's a pretty big well. I don't want to just say too much, but it produces, more than 0 barrels a day and less than 20,000 barrels a day. But it's a lot of barrels per day for one well. And so when that well is shut in, it makes millions of dollars a year, if not hundreds of millions of dollars a year. So everybody's asking about it all the time. So having that ability to monitor it is very crucial. And I keep track on some of the other assets that we have in the organization as well. But if you have any specific questions about Palantir, more than happy to dive. Otherwise, I encourage you. There's a weekly chat that we do every single Friday or Saturday about Palantir, and I'm on there. And instead of just listening to me be an echo chamber, I've been invested in Palantir since September of 2020 when it direct public listed. So, and the first time I mentioned it on the channel was October 2020. It's been a journey. It's gone up to $40. It's come back down, but I've never sold a share. And I think it's, as I alluded to back in October 2020, it's a very long-term play. But if you have any specific questions, man, I'd be more than happy to be chatting about it. My thought on the Fundrise REIT, I go back and forth. The thing that bothers me a little bit is it looks like the dividend yields have kind of come down a little bit, which is one of the reasons why I invested in the Fundrise REIT. But it also looks like they're taking away some of the things that were beneficial about it. Like we're trying to make it more of like a standard investing template. You either invest in growth or you invest in income, and that's really it. The thing that I enjoyed most about it is you can kind of direct and see what specific projects you'd be investing in. So you could look in the East Coast, you could see you're investing in DC, New York. You look in the West Coast, you could see you're investing in Las Vegas or LA or what have you. And you have that a little bit more granularity. But at the same time, I recognize how that's cost prohibitive, and the structure of that would be difficult because of all the different filings. And then obviously you have all the accounting headaches to understand, well, this property is a part of this REIT, but not that REIT. And, so I understand the simplification of the cost structure and why they would want to do a simple Fundrise REIT rather than what they're doing now and simplification of that. But I think it's a good diversification. But at the same time, like I haven't seen the absolute returns that I've kind of wanted. Let's just say, for example, I've probably made overall $2,000 on the account. I'm investing on and off since 2017. I know not all of it is, and I should make a video about this, so keep your eyes peeled on that. But not all the $14,000 or $1,000 or so that I have in Fundrise has been invested since 2017 day one. But I feel like they were always touting a big game, like, oh, we're north of 10% annualized returns and yada yada yada. I think if somebody that is scared of the volatility of the stock market and doesn't like seeing negative numbers and always kind of wants to see it slowly ticking up and to the right, I think Fundrise is probably a good place for you. If you're somebody that has a little bit more stomach for volatility, I'd stick with equities personally. But I think overall, and I was thinking about this earlier, and I was hoping we were doing a Palantir Weekly so I'd have a bigger audience to talk to this about. I've had some people that have caught on to, because I've refrained from sharing exactly really how much I have as a net worth these days. And I think within the past year, I kind of stopped doing that. And I thought there was, because it was like more the words that were coming out of my mouth rather than the number. But I think with some of the things that have come out, like me buying rental property and just me also just being more blatant about like, yeah, there's 7 figures there. And I'm relatively young. People think that there's a magical formula. Like, no, like there's no magical formula. I busted my ass and saved a lot of money. And, people are like, oh, but you have a high income job. Okay. Like while other people were partying out in college, I was into the library at 2:30 in the morning and, ordering food from my phone so I could eat before I went to bed and crash and then wake up at, 8 o'clock and get to class at 8:30, and do it all over again. So while you guys were out partying, I was kind of busting my butt in college, and that kind of continued for the first few years where I was, kind of splitting my hats in multiple roles and, going to Trinidad and, yeah, I had a lot of fun in Trinidad, but, and I'm not saying I didn't have fun either doing a lot of that stuff, but, a lot of people would go out every single weekend and buy bottles. And I've been out with some of these people, man, they don't have the money, but they're still out there buying $400 bottles of Tito's and, having everybody drink. And they're like, oh crap, the Tito's is gone. Let me buy another one. It's like, dude, I know you don't have $800. Like, why are you doing this to yourself? And so it's pretty funny how people operate and how they try to perceive. But at the same time, you have to have fun. You have to, it's a pros and cons game. But I think at the end of the day, people think that there's a magical scenario. And I see these people on FinTwit and stuff like that being like, oh, there's this magical formula, and they try to shorten their way. But it's like, if you listen to some of even the craziest people that make these crazy bets, like I'll just take Sachin and Chris, for example, they still have very conservative, at the end of the day, like base foundation portfolios. And what they're using as gambling money is only a portion of it. Whereas I think the opposite goes for the majority of people, where they try to use like $1,000 and gamble it all away, and they have like $20 and something simple like the S&P 500 or ITOT, and they have it reversed. And what I did is I would just truck away as much money, 30-40%, some years 50% of my income, into, because I'm just a single guy, right? And I don't have as many, there's two things that I love to kind of spend money on. It's like decent food and good drinks, whether that's, alcohol or, just hanging out with people. And I think a lot of people, they'll put their time, energy, and thoughts into everything but their financial security. And that's okay to an extent. But if you have the right processes set up in place, then your money's going to go everywhere where your attention goes, and everywhere, and it's not going to go where you don't have your attention. So if you're not focusing on it, or you don't have a good system in place, your money's going to go everywhere but in your own pocket. So I'm a huge believer in paying yourself first. And I think a lot of people's eyes glaze over when they're like, this guy doesn't have a magical formula. Nobody does. And even if you did, right, even if you were the next Warren Buffett and got a 20% annualized return, you'd still have to have $1,000 or more than $1,000 in your account, annualized 20% over the next 20-30 years for it to do anything, right? Like you can't just put $1,000 and be like, I'm the next Warren Buffett and only have $1,000 and really assume that you're going to get anywhere. Like, I think it's pretty funny. It's just like, no, man, like you have to be consistent. And the thing that I like to say, the easiest thing to do, which I think is like people like, they're like, oh, duh, Matt. And I'm like, well, if you have $1,000 and we get to $1 million, what's the easiest way to double your chances of getting to $1 million? And the answer is add another $1,000. But people think that there's some magic formula where they're going to go from 1,000 to 2,000 to 4,000 to 8,000. It's like, yeah, over decades, yeah, that'll happen. But the easiest way to go from 1 to 2,000 is add another $1,000. Like that's the easy part. But if people don't really look at the easy part, they care about the hard part. And the hard part's not touching it. The hard part is like literally just, so anyway, I diverge on that, but I think it's pretty funny how people are like, and then to answer Nate's question, how old am I? I'm 31. I'm about to turn 32 next month. And so done relatively well. And even with that, I've made a lot of mistakes. And anyway, with that, I could easily probably have close to 2 million, but the mistakes I've made, unfortunately, I can't take back. You can only look in retrospect. So anyway, I'm missing some questions here. So let me go back. So if I want to know about Palantir, talk to Dave. Yeah. So thoughts on Berkshire and the Japanese trading companies. I am pretty peculiar about it, to be very frank. I mean, I haven't done too much research other than the yield 5%, their PEs are single digits. And so maybe the arbitrage play here is when markets get and rebound, they'll do well. And I think the fear that he has is, I don't know. It's a good question, but you have to think like some of the like he already sold out of Wells Fargo and the majority of his position of Wells Fargo. So that was going to happen. And I did the same. Like a lot of people have reached out to me because I used to be a big Wells Fargo bull. And I thought it was a one-time thing with kind of what happened in 2018. And I thought that they were kind of with respect to like the account scandals where they're opening up. And I thought there was a good arbitrage there. And there was. I made a lot of money, specifically adding when it was below $20 and it kind of ran up to $50. And I had 1,000 shares at one point. So, I turned a decent amount of money. I think my cost basis was in like the low 20s because not every share that I bought was below 20, but my cost basis was in the low 20s. And so I doubled the money and I was like, I don't think this is going to stay at 50 for very long. And that was after the pandemic. So like late 2020, early 2021, I took that money and put it elsewhere, probably to some crappy tech stuff, and I've lost all of it. But regardless, when you notice that a company's culture is toxic and it's not going anywhere, it's better to just leave it alone. And I've seen that time and time again. Like AT&T is a toxic culture, and I don't think unless there's some major efficiencies found there, I think AT&T is eventually going to head towards bankruptcy. And I see a couple other ones like that as well. They need to really turn it around and switch back to being an innovative company rather than focusing strictly on the dollars and cents of things. But really what I'm getting at is Warren made really good investments in 2020, 2008, when the banks were kind of at their lows, picking up more stocks. He did more oil in 2020 than banks. But like Bank of America, for example, he was buying options contracts from them at a special price of like less than $10. I forget. It was something stupid. It was like $3 or $5 basically to give them $5 or $10 billion. I don't remember. It's been a couple of years since I've kind of remembered it. But since then, BAC's gone above $30 a share. And with all the dividends that he's collected, like, I don't know. Do you really think that they're going to do really, really well? The thing also, though, is what I don't really realize or know about is, are these trading companies similar to what a Berkshire is, right? Which is like, are they insurance companies disguised as trading companies? Because that's really what Berkshire is. Berkshire is just an insurance company disguised as a trading company. Like they just take all the float and they invest it in great cash flowing businesses that do relatively well. And it wasn't really until Berkshire acquired Berkshire Hathaway, which was the insurance company that really, or sorry, not Berkshire Hathaway. They bought Berkshire Hathaway as a business, and then they started actually utilizing Geico and some of the other insurance companies that they've acquired over the years to truly expand the float and do really, really well. And that's what the real business is like using the insurance to collect hundreds of billions of dollars over time and invest it in great businesses and then continue to buy other good businesses that spit out a lot of cash flow. Not that he's the best investor of all time. Well, he is the best investor, one of the best investors of all time. But my thought process is, sorry, I'm like mixing up my words, but I think one of the things that you have to realize is I think he's giving more and more the reins to the folks that are going to be taking his place in the future. And it could be warranted. And I didn't really read or listen to I think he had a very early morning on Wednesday when CPI came out with that lady he always talks to on, is it CNBC? She does a really good job. They've had a really good relationship and all the reports are really, really good. I forget her name, but he talked a little bit about it. And I was too busy doing something else. I think I was preparing for an interview or something with the CEO that I didn't get to listen to the entirety of the conversation. But I wouldn't be surprised if it was one of his second in commands that really made that, but I really don't know. Specifically, I anticipate this is set up specifically to announce for Palantir. This was the AI announcement, historic game changer, another good sign. I have a very different point of view on this, and maybe this will click for some of you guys. Maybe it won't, because it seems like I've said this on Palantir Weekly last week and a few of the other conversations, and I've kind of gotten heat for it because I'm not some big fanboy that's like all of a sudden being like, oh my God, AI, it's the biggest thing of all time. So AI, artificial intelligence, has been a huge part of what Palantir has been doing for many, many moons. I've seen it used in my business personally, not just AI, but Palantir's AI and what they're doing, how they're implementing it, how they're using it to create more oil production, how they're using it to create digital twins. And so when this announcement comes out, now everyone's realizing that, oh my God, Palantir has this AI capability. It's more business as usual for somebody like myself that has seen the background inner workings and webbings. What I think is the most new part of it, and the best part of what I think they're doing, is more the clarity around how to utilize the AI and interface with Gotham and Foundry in the background, is the Chat GPT like AI structure that you can use. So it's not like a digital twin anymore. It's like you almost have like a Cortana or a Siri or like an Amazon Alexa type interface that you can then ask questions and it goes out and searches for you. And the true benefit that I see in Palantir's AI product that I won't see in like a Chat GPT or something of the like a Bard or something like that, is the integration of the enterprise data that, say, an Exxon or a Tyson Foods or a Ukraine government or army can integrate with public data to be able to make decisions in a more rapid pace. And so that's that interlinking of the enterprise data that needs to be kept completely secret and not public to anyone else in the world, coupling that with large language models that incorporate and connect and like allow you to kind of integrate the enterprise and the public, that can truly have massive benefits. And I don't think that that's any different than what's been going on, but I think the ability to use it for an everyday user like myself or somebody else that has access to Palantir, Foundry, Gotham, what have you, is extremely powerful. What I don't see this as is a public tool like a Chat GPT or something the like. Now, what I continue to observe, and this gets me in heat with people like Joseph Carlson, who I respect immensely, but I think he's wrong on something like a Palantir, is I see what Microsoft did in the 80s and 90s as to what Palantir will do in the latter half of this decade and the early 2030s, which is truly unlock the next massive amounts of efficiencies for enterprises. And what I mean by that is like, imagine before Microsoft Word came around, Word documents, PowerPoint slides, like we use PowerPoint, and that's legit. Like Microsoft's Word, like they've monopolized that word, right? These slide decks, I guess, is the correct term to help present material. You know, all these sorts of things really revolutionized how enterprises operate and make them more efficient. And what I think now we've kind of gotten to is that is now business as usual at any organization, in majority of organizations, right? You have either like a Google Docs or you have a Microsoft Word or you have any sort of word processor, you have their slide deck sort of software, And you have a few other things that might be able to, allow you to use email, whether it's Outlook or Gmail or what have you. Now you have the cloud services, which makes things more efficient because you have multiple people working in documents at the same time. And now it's time to integrate really, instead of manual interpretation of data that people are used to doing, which is being able to collect data. Now data is being collected so quickly with the Internet of Things, with sensors that are being more and more used, that the Bluetooth aspect of things, which is able to transfer data very quickly. Wi-Fi, like as much as an increase of that was going from wired to wireless internet, stuff like that, where you're seeing all these efficiencies. Palantir is looking at the next level in terms of like, okay, let's take a word processor, let's take an Excel workbook, let's take all these different things and truly understand how the analytics and the data and understand and massage it and what is it actually telling us to do. And that previously, like you could do that manually, but a lot of times what ends up happening is there's so much data that you might look at one thing and you might not realize that it has an inverse relationship or a direct relationship with another piece of information because your eyes aren't looking at it. And so when you have something like Palantir where you're able to store or move quick data very quickly and put all these different data pieces against each other and plot it very quickly and efficiently, and you have these models that now are able to look at things and say, well, if you close this valve, this is going to happen. You have the digital twins of the world being like, let's close this valve. Oh, pressure is going to build up over here above your safety limits. Don't do that. Stuff like that, where you have the places and the protocols and procedures in place to understand what's going to happen if you turn a valve this way or that way. I think that is truly what's going to be beneficial. That means you're going to have more, chicken nuggets being made by Tyson Foods. You're going to have more oil coming out of the oil production facilities that are in the Gulf of Mexico. You're going to have more people being analyzed, diseases and stuff like that, like we had seen in the most recent Foundry Con, and help document symptoms and stuff of the like to help, make sure that people aren't wrongly diagnosed. You're going to have the ability to store data in the NHS. You're going to be able to help monitor inventory levels and set, limits of when certain things need to be ordered, whether it's face masks, whether it's needles for vaccines, whether it's for, saline bags, things like that, which allows you to truly see the data, which previously was just being stored in an Excel document. And what good is an Excel document if it's not connected up to some sort of larger database that helps you understand and visualize and understand the data? Like you could put as much data in an Excel spreadsheet, but if you don't have it organized well, this is not going to mean anything. So anyway, my long tangent on this is to say, this doesn't change my view on Palantir at all, this particular announcement for AI, because I've recognized that AI has been embedded within the organization all along. And so to me, it's awesome to be able to see what Palantir is doing from the AI perspective, but I've seen it for the past few years. And so to me, it's not anything new. To others, it's revolutionary because they're finally realizing how efficient and how well placed Palantir's software is with connections with Foundry, with connections with Gotham. And because they haven't done enough due diligence before, or because they haven't really done as much listening as they could have, they're finally coming around to the fact, because Palantir is now explaining it more eloquently than they have in the past. And because their products are difficult to use, because their products are not difficult to use, because their products are a little bit more on the frontier side of things, people are hardly understanding what exactly they're going after. They just assume that it's some sort of like secret government agency, and or some consultant for super secret government agencies, and they kind of just leave it at that and kind of like shrug their shoulders. So to me, business as usual, right? And not to say that that's not exciting. It's extremely exciting. It's extremely revolutionary, but it's not new. So Anyway, I know that causes a lot of controversy, and I've explained it in kind of like shorter terms on Palantir Weekly, but I really hope that hits home for some people. And I put a pretty good video up on my channel that's not monetized because there's some things on there, that music and some of the videos and stuff that got it demonetized, and I'm perfectly fine with it. I'm more than happy to kind of help educate people, because I'm not saying I'm not excited about it. I'm extremely excited about it, but that's part of the reason why I've been extremely excited about Palantir since day one, because I know these things that are going on. It's not new. It's just business as usual, but it's just being repackaged. And I think Sachin hit it perfectly on Palantir Weekly last week. So yeah, Carp has been on it, and I think a lot of people don't really realize it. And so, yeah, I think that is truly, honestly, where I'm at. 2030, it's going to be a crazy. I don't want to say it's going to be an I told you so, but it's either going to be really, really great or just really lackluster and nowhere in between. I don't think it's going to be some company that's $20 billion. It's either going to be something completely has fallen flat at its face, the culture fails, everything kind of starts to head towards zero, and the culture just becomes toxic and it ends up not being anything. Or to me, it's truly going to it's truly going to push enterprise and enterprise software into the next frontier, just like Microsoft did in the 90s. Putting money slowly into Fundrise, your bulk and your investments via M1 Finance. M1 Finance is a great product, truly great product. So yeah, I think M1 Finance, for those folks talking about specific earlier, the folks that could set up great processes to ensure that they're saving money monthly to ensure that they get to their investment goals. M1 Finance is a great product to do that. Because you could set up a pie. You could say, I want to do the S&P 500 and I want 20% to go in these other 20 random stocks, because I just still want to gamble a little bit, because I think I'm the next Warren Buffett. You have that opportunity. It's not good for folks, though, it's not good for folks that, however, like to move their positions very frequently and swing trade. Adero is a great opportunity for those that are okay with the volatility that I might see. I'm a firm believer that it's a very competitive environment, and I need to see personally a little bit more execution from the organization. I don't devalue anything that Ryan or Marush or Kyle have said about the organization. I do think that it's a potential great opportunity, but I just think that something like that, personally, could just be executed a little bit quicker, and the trials could be executed a little bit quicker. But at the end of the day, I think they're doing a great service. And I think that companies like that, that are truly trying to revolutionize lower carbon emissions and make things more efficient all around, and reduce plastics, are going to do extremely well. And I think that's going to be eaten up. And I think that's a revolutionary thing that in the next 10, 20 years, people are going to be fighting for very well. It's making sure that we don't use excess plastics, and we don't, we reuse plastics as much as we can, and we use them for the greater good rather than just one-time use plastics. And I think Adero does a really good job of helping with that problem that we currently see. I just think that, it could be something that's executed a little bit quicker, and with a few more catalysts, it could be something that I put some more money into. But I think some of the deals that, they've been working with Shell and stuff of the like, and unfortunately, I don't do as much research. I did some research when, presented the opportunity a couple months ago with Ryan. I was very fortunate. I do think it's a great opportunity. I could see that company being worth billions one day. But yeah, Ryan's kept up with it a lot more. And to me, I think it's still too early, personally. The product is kind of like in a pre-revenue stage almost, to an extent. And once it gets to the point where it's more churning out capital and it looks like there's a runway to not being cash burn and stuff of the like, it might be a different conversation. Um, but until then, yeah, I'll just kind of keep my eyes open on it. Would love to do more research on it, by the way, as well. There's other companies I do research on, like I do Palantir, Rocket Lab. I have those other analysts, kind of duties that I do for those organizations where I have an obligation and, to people that watch the channel and that I have more skin in the game in. And I think that they're a little bit more mature. So, not to say it's a great opportunity. I think you should do due diligence. It could be something where I'm trying to remember. I'm just trying to remember where it is in terms of market cap. ACTHF, right? In terms of market cap, it's like 50 million US, 40 million US. Let me get my calculator. Yeah, I could see it going, 25 to 50x. I could see it going for a $2 billion or more in the future, sort of market cap. I could see that. But I think it's just too early. Eugene says, "What are my thoughts on long-term oil and gas industry, if that's the correct term?" Uh, I think the thing that is overlooked is that you'll have more efficiencies happening in the Western civilizations like the United States, Canada, Europe, that will be, and to an extent, some of the Far East countries as well. South Korea is really good. Japan's pretty good about, transitioning. China, India, they're all trying to reduce their carbon footprints to an extent and align with the 2015 Paris Accord. The efficiencies made by those countries rather, to align with the 2015 Paris Accord is going to be heavily offset, if not fully offset, for the next few years in the growth that we see in Africa. So Africa is still growing at a very, very quick pace. Nigeria is growing very fast. And the unfortunate thing with Africa is that a lot of the countries don't communicate as well, because of, I'll just be point blank, the imperialism that happened in the 1800s and 1900s, which drew, I would just say, borders that don't necessarily align with what the true people may or may not adhere to. I think it's very difficult to create something like an EU. It's very difficult to create something like a United States. It's very difficult to create something like a great trade agreement like we might have with Canada and Mexico. As much as we might think that it sucks, at the end of the day, we still do really, really well. And so that fighting in between Africa makes it very difficult to do something like a good power grid associated with solar, associated with wind, and then coupling that with the vast size of Africa is truly underrepresented in every sense of the word. And so transmission lines is very difficult. Like, with transmission lines, you lose a lot of power. And so this is difficult. So to answer your question, I still see us growing, if not staying flat, for the next 9 years. I would say by the time you get to 2033, you might see a fall over. But I think that we're still using 100 million barrels of oil a day. I don't think people understand this. They think, based if you listen to like CNBC and some of these other news articles and stuff like that, oil's going to zero, right? We don't use oil anymore, right? Oil is useless, right? If you listened in 2020, everything was about ESG, solar, wind. The problem that I have at the moment is not that I'm a disagreeer of solar, wind. In fact, I think I think it's a great opportunity. I think that the benefit of those things is you're able to align trade agreements much more easily. You kind of have an idea as to the loss of efficiency or loss of capacity of output in a solar and wind farm, because it's a lot more tangible than, say, like an oil and gas asset, which is more variable. You can't, you're drilling thousands of feet below the Earth's surface. You have no idea how much is really there. You can only estimate, a certain amount. It's very capital intensive. Not to say that wind and solar is not, but the thing that's beneficial about wind and solar and nuclear as well is you have the idea when you install it, the capacity outputs that would have. The thing that bothers me a little bit is when people quote the capacity, I forget what the term is basically, but the capital efficiency associated with how much capacity you get, right? So let's just say it costs, I think this was these are close to real numbers. It's going to be messed up, but it's close to real numbers. It costs about $6,000 per megawatt of energy, like megawatt hour annually or something like that. $6,000 megawatt annually or something like that to install a solar panel and wind farm. Like, they're pretty comparable. Capacity, right? 6,000, let's just say 6,000 capacity for 1 megawatt. It's going to cost you $9,000 or like $7,500 to do 1 megawatt capacity. Hence, like, very hard emphasis on the capacity for nuclear energy. People are like, oh, well, why aren't we doing more solar and wind? Capacity is the key term. 1 megawatt of capacity in a nuclear is going to give you, let's just say, for example, a gigawatt nuclear plant is going to give you about 900 or 850 megawatts of power. So at 85 to 90%, efficiency on the capacity. Solar, it'd be lucky to get 25%. So if you have a gigawatt solar capacity field, you'd be lucky on an annualized basis to get 250 megawatt hours. And the same with wind. Wind's a little bit better though. So you might, if you're lucky, get 35%. So if you have a gigawatt wind farm, you'd be looking to get 350. So yes, it's cheaper to install a gigawatt capacity for wind and solar. But when it comes to the actual efficiency and the actual output of those power plants themselves, or the sources of energy, nuclear still wins. And same with oil and same with natural gas plants. And so when people, it's like kind of a catch-22, right? Because you see these great efficiencies being made in the solar industry and the wind industry to get the prices down per kilowatt energy hour. So it's like however many cents per kilowatt. And the efficiency of these things are doing really well. Rocket Lab, which is one of the things that I invested in. So like, for example, I know I'm tossing like a lot of different figures around, but if you go on their investor presentations, it says it perfectly. First Solar, I looked up. The First Solar Series 6 panel is 17% efficient. So the energy that collects on the solar panel, it's able to turn 17% of that into energy. That's phenomenal. Rocket Lab, which is one of the things that I love the most and invest in the most, I just told you 17% for First Solar, right? That's US based solar panel maker that builds things for use on the Earth's surface. The thing that I love most about Rocket Lab, they built Solera, is a company that they acquired over the past year or so. They have solar panels that are razor thin. They are 33% efficient. So not only are they double the efficiency of First Solars, but they're razor thin. They are being used to put satellites. Obviously, when you think about it, you need to use solar power or something that has infinite power lengths or years of power lengths. You can't do it on a battery. You have to have something that creates its own power, which is Solero, has these solar panels that do a phenomenal job. So anyway, I'm really excited about that. But the thing that bothers me is you have these people quoting these numbers about capital efficiencies made. And I agree, there's capital efficiencies being made. But the problem is in order to get the same amount of energy output of a nuclear plant, you need to install 3 times as much solar and wind. So when we quote these things, we're like a gigawatt solar plant, a gigawatt wind plant. When we talk about that, when you look at capacities, it's like, oh, well, the capacity for these things, like we have a gigawatt, nuclear plant. Let's just replace it with a gigawatt solar plant. That's where you have these issues like you have in Texas, where they're like, we're trying to go renewable, we're trying to be more efficient, but it's like, you can't just do a like for like, because the one output's like, when it freezes and the windmill and the wind turbines freeze, you're getting zero energy output. And when snow covers your solar panels, and I'm not trying to say I'm against it, right? I'm for it. I see that the revenue streams are generally speaking better, because you're able to say you lose 1% of the capacity output every single year on a solar plant and a wind plant versus an oil and gas. Sometimes the declines on those oil and gas facilities is 20, 30%. And, sometimes you're in, different environments, different chemicals, corrosion, all these things that truly attack it, and very capital efficient or inefficient. You have to continue to drill wells, because when your energy is decreasing by 20, 30% a year, you have to continue to drill. But anyway, long answer to your thoughts, or to your question rather. I see it's using 100 million barrels a day, which is currently at 101 million barrels of oil used a day. I see us going out until 2032 at about that same pace. And some people are like, oh, some people say it's going to drop to 90, like, ha, 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 ha. It's like, it's still 90 million barrels of oil a day. We use 100 million barrels of oil a day. Like, the fact that you think it's going to zero tomorrow is hysterical. Like, you need so much capital. It's insanity. So people are laughing. And so this is what I'll leave you with is, you either need to look for oil and gas companies. If you're looking for it, you need to do one of two things. You need to look at the industries that are growing rapidly. That's offshore wind, onshore wind, solar, and invest in the companies like oil and gas that are investing in those companies and transitioning, because they're going to be going from something that is either staying flat for the next 10 years and transition into something that's growing at a pace of 20 to 30% per year per annum, and capture a market share of that. So the point that they, let's just say, have a 1% market share ownership in the oil and gas market, they can grow into a 3, 4, 5% market share ownership in solar, wind, offshore, become the Saudi Aramco of the renewables, where, let's just put in, for example, Saudi Aramco, they claim to make 12 million barrels oil a day. Some of that's gas, some of that's NGLs. In reality, they make about 9 to 9.5 million barrels of oil a day. The market creates 100 million barrels, so they own 9.5% of the market share, which is pretty impressive, right? When you look at some of these other companies around the world, some of them are making 500,000 barrels of oil a day, some of them are making 1.5, some are making 2 million barrels a day. So you're talking about 0.5%, 1%, 2% market share. You have to look for the companies that are transitioning into the world we will be in, or, right, meaning like they'll be transferring their money that they're getting from oil and gas and trying to grow into a growing industry and capture a large market share of that industry. And at the moment, I think the one that is leading that is Shell and Total. I think those are doing the best. And that's why I have a lot of my money in Shell, because I think that they're going to continue to do extremely well in the oil and gas industry. And I think that they will eventually transition really well into the renewables industry. But Total, I think at the moment, has the biggest ambition of being the largest. And so that's why I think Total is somebody to keep your eyes on, especially if they continue down that path. Now, that doesn't mean you should get out of oil and gas, because, as I alluded to, over the next 10 to 20 years, you're still going to need to use billions upon billions of barrels of oil. So what you need to be looking at is companies that are being capital efficient. They're not taking on too much debt, that are looking at increasing their margins, that are looking at creating established positions. Like Exxon, I think, is doing a really good job in the Permian, because they continue to buy other positions around it so they can continue to kind of cookie stamp and make it like a factory, right? So the inefficiencies of having lease blocks that are not completely next to each other reduces the ability to drill longer drill longer horizontal sections and be able to capture higher EURs per well and stuff of the like. So anyway, I could go on and on forever about that, but that's just my biggest thought is like, watch and truly listen to the words that people say about this transition, because there's so much politics involved with a lot of this stuff. And like I said, I'm fully for the transition. I get it. Like I see, like when I see a very smoky car when we're driving down the road, you know what I mean? Like I work in the oil and gas industry, like it doesn't, like we all breathe this air. You know what I mean? Like we're all here, right? Like I don't want to breathe your smoky, like crappy exhaust fumes. You know what I mean? So, and that's kind of the way I look at it. Like I don't think anybody would these days want to do that. So it's all about efficiencies that you can make and make things more useful and stuff like. And car engines have been more and more efficient over time. But anyway. So hopefully that answers your question. Sorry, it's a really long-winded answer, but hopefully that's a good education there. Stock you've highly considered but can't pull the trigger on. The one that I couldn't pull the trigger on, which I'm kind of biting myself in the butt with, is I really wanted to buy Tesla in the hundreds, low hundreds. But at the time, I just didn't have any capital because at the same time, everybody else was doing crap, and I wanted to buy more and more Palantir, Amazon, and Google, and yada, yada, yada. One of the ones that I keep dancing around with, which really upsets me. So I don't dislike Disney, right? I have a Disney position in my Roth IRA. But since I've owned it, it really hasn't done anything. Like it's gone up to 190 and it's come back down. I'm a true believer that I think in the long term, Disney's a great product. And I think after they get out of this point where they're utilizing their dividend that they cut and utilizing a lot of the cash flows to feed into Disney Plus, and they get over this hangover associated with the pandemic, it's going to be a cash flow generating monster. And I already see the results of that kind of shining through personally, but I just don't think the stock is caught up with it yet. And I think you originally were kind of seeing it when the stock was going to 190-ish after the pandemic. And then unfortunately, it's kind of come back down because of the hangover, and all the stocks went down in 2022, right? Like that's neither here nor there. What I've contemplated over the past year or so is I continue to see this monster in Microsoft. And so I'm sitting here being like, and this is actually a really good conversation piece. So I continue to see this monster in Microsoft and a monster in Amazon. So part of the reason why I invest in Amazon is the monster of a cloud business. That's inevitable. And then two, this $550 billion a year e-commerce business that is intentionally losing money. And so when they decide to be a Walmart and be like, let's get some drip, like they could easily be like, okay, instead of losing 1 or 2% a year, let's make 1 or 2% a year, which I think is kind of what they're trying to do right now, trying to remove some of the slack, stop investing in so much in warehouses, get some more efficiency, lay some people off. And unfortunately, when you're growing at a massive rate, it's very difficult to balance the books and grow as fast as you can, especially a company like Amazon, which grew revenue so rapidly from 2019 to 2021 and 22. So to take a step back and say, let's close some of these warehouse positions, let's hold off, let's wait, and let's be slower, more diligent, and more, no, diligence is the right term, be more diligent about what we're doing instead of just being so fast paced. Let's get the efficiencies in. I think in the next 5 years, you're going to see Amazon, I don't want to say have a complete pendulum swing, but start to be more of like a, hey, we're dominating. Let's start to get some cash out of this thing. And it's going to be a completely different story. Microsoft is a close number 2. And I've had some good conversations with Bailey. She's a good friend that has taught me a lot about the cloud business and discussions about that. And from her learnings and what she's taught me, is that the cloud businesses of a lot of these organizations are still very much in their infancy. And that's the only reason why I haven't sold my Alibaba shares. I'm down massively, I think like 50% or something on my Alibaba shares. I'm a firm believer that in the long term, that cloud business is going to be worth a lot. Granted, it's unfortunately housed by the CCP, which I don't want to get involved in that and get demonetized and, all that stuff that comes with talking geopolitical issues on YouTube. And that's just not what I go for. But I'm just a firm believer that cloud is a great moneymaker. And so my fear is not owning Microsoft. But I do own a lot of SPY, right? So in Devo and JEPI and those kind of in XYLG, and those kind of invest a portion of that money into Microsoft. Now, the thing that I'm going to surprise you with that bothers me a little bit is Palantir, and I've had debates about this as well with folks, is Palantir uses a lot of cloud. And one of the things that I think that Palantir might be smart to do is slowly use some of that capital to allow them to be an opportunistic cloud provider. Now, it's tough, right? Because Palantir's MO isn't 100% about like, let's make as much money as fast as possible. And I think cloud is a very capital intensive business and stuff like, but like, if you think about it, the amount of cloud usage that Palantir has, storing all this data, Foundry, Gotham, everything, the business that we use most and store a lot of it's mostly Azure, which is a Microsoft product. But we also use AWS at my company. But you think about it, it's like we spend millions. I don't know how many millions, but millions. And that money could be going to Palantir. Instead, we store all of our data basically on a Microsoft cloud or an Amazon cloud. And then Palantir's Foundry has to go and collect and then bring to the screen. And, so my thought is like, is there efficiencies if Palantir creates a cloud business? This is where I get my hand slapped a little bit, but I think that they could grow it slowly. And I feel like they could hire the talent to make it something that's really useful. Instead of relying on an Amazon, Google, or Microsoft. But at the same time, the fact that they have that connectivity to Amazon, Microsoft, and Google is also really good. Because a lot of people and a lot of big enterprises already use them as cloud providers. So it kind of allows Palantir to kind of plug in. So anyway, it's a thought. But you think about it, the margins maybe on a cloud business are in the 50s and 60s. But that's the thing is like the operating margin for Palantir is going to be in the high 70s and 80s. But at the same time, you can't just like reinvest back into a Palantir like you can like a cloud business. You know what I mean? It's like you'd have to hire more people and connect with more enterprise. It's more sales based versus like a capital reinvestment. So I don't know. It's always bothered me why Palantir doesn't have more of a cloud business personally. Knowing that their entire business operates off of the cloud, right? Sorry if I'm running behind. These questions were asked 45 minutes ago, and I'm now just getting them. As a young man about to be 24 years, what is something you learned later in life that you would go back and tell yourself in your early 20s to be better financially educated? Investing in, step back, perspective is key. Playing the right game is key. So say you're 24 years old, right, David? Hopefully you're still here. If you are, or if you're not, the other 19 or 20 of you guys can listen and hopefully take this away. Let's just say your best power is, I guess, two things: perspective and opportunity cost. And I don't necessarily mean opportunity cost as in like do this investment versus that investment. I mean your time opportunity cost. And so what I mean by that is like I could spend hours researching stocks and trying my best to be a day trader and stuff of the like, and I'm probably still just going to end up underperforming the market. What I am good at doing is going out hustling, finding opportunities, working, getting, some side hustle income where I can make a couple $1,000s in a couple hours and using that money to rather just invest in long-term investments. And so you have to kind of understand where your power is, right? If you're a phenomenal day trader, then use that to your leverage, right? But what I end up finding is the majority of people are not good day traders, and they'll spend so much time sinking it because it's fun, it's a hobby. I get it. I love it too. But you have to fight that urge. Very early on in my career, I would spend so much time researching stocks, and like now to me it's more important about just making sure that my money is going into the markets and that I'm more of a long-term investor. I can't control as much. So focus on a few key stocks where you might be able to outsize your returns. To me, that's Palantir, that's Rocket Lab. It's two companies, maybe a BABA if you want to include that. But the majority of your other funds are most likely better used in an index fund. I'm not saying ETF, because ETF, everyone thinks an ETF, you can just put it in an ETF, and it's ETFs, you have to realize, have different prospectuses or prospecti. But regardless, it's like you can have an ETF that the sole purpose of the goal and the prospectus of that ETF is to match emerging countries or match India. Like an ETF is just a way that somebody is basically investing in something on your behalf, right? As a bucket. That bucket could be investing in dairy farms. That bucket could be investing in eggs. That bucket could be investing in oil. And so if oil does bad, that ETF's going to do bad, right? So what I think a lot of people do is like, I'm just going to invest in this ETF. My money's good. I'm investing in ETFs. It's like what you're investing in potentially is garbage, right? Like sector ETFs, for example. You're investing in a real estate sector ETF. Not all the cases, but you might feel comforted because you're in real estate and you have an ETF. And it's a sector ETF, and it covers commercial, it covers multifamily, it covers residential, what have you. You're also investing in that ETF, likely garbage companies, just like the S&P 500, for example. There might be some garbage companies in the S&P 500. The great thing about investing in some of these indices and the S&P 500, for example, is there's set criteria to be part of the S&P 500. You have to be profitable over the last 12 months. And a bunch of other different criteria that basically mean that if you're not doing what you're supposed to be doing, you get kicked out. And whoever is doing what they're supposed to be doing gets brought in. And so before the company goes from doing really, really well and it's climbing, it starts having a couple bad quarters, it gets booted. So you're not enduring all those losses, right? So it's this perfectly managed mutual fund that meets these bylaws that does extremely well. So I would say just understand that perspective, time, opportunity cost. But really, if you just take a 50,000 foot view of kind of what I said, how you can determine whether or not, say, investing in an index fund or investing in real estate, doing flips, doing entrepreneurship, doing any of these things is really for you. And I've based it off these 5 things, right? So what's your objective, right? It could be what's your purpose in life. It could be what's the goal? Is it money? Is it family? Is it, and this is kind of the basis is the other 4 things that we're going to talk about. But granted, this is not really like a spiritual thing. It's more of a financial thing, right? So it's trying to understand from a financial foundation perspective where your head is at and hopefully point you in the right direction. Because in my opinion, there's no one way to get to your investment goals. It's based off of what's right for you, and it's personal finance, right? It's not, hey, Warren Buffett did it, so it's going to work for me. Warren Buffett spent 60 hours a week over the past probably 70 years to get to where he's at today. Maybe you don't want to spend 60 hours a week researching and doing what Warren Buffett did. You see what I'm saying? So the first thing out of the 5 is objective. What's your objective? Let's say you want to make dividends. Make sure you want to retire early. Make sure you want to, buy a house in 10 years, right? All these things are the fundamental underlying reason for all the other things that you're going to do. And the other 4 things that I'm going to ask you to kind of think about introspectively that might fit for you. And don't lie to yourself, because if you lie to yourself, you're more likely to make a mistake and make rash decisions. Number 2, what's your time horizon? That could be incorporated into your objective, right? But let's say it's in the next 2 years. Maybe it's in the next 5 years. Maybe it's the next 10 years. Maybe it's generational. It's really going to set the frame for what wavelengths we're talking in. Does it matter? If you're like, I want to buy a house in 2 years, and you're like, I'm going to invest all in the stock market. Well, let's just say another bank collapses and we decrease the equity by 50%. You're going to be able to live with that. But that gets into the third thing, which is risk tolerance, right? Would you be okay with whatever you're investing in decreasing by 50%? Or is seeing any sort of, red, negative, scare you to death, right? Let's just say you have $10,000. It's your $10,000. You want to make sure it only goes up and not down. If you see it go to if you see it go to $9,999, you're going to freak out. And you're going to pull your hair out. You're going to sell everything. And you're never going to invest in the stock market again or whatever. If that's the case, CDs look really good right now, right? Very little risk, under $250,000. You could make, if you don't ever want to see any darkness in your portfolio, hey, you might not make as much, right? But you're still going to get a little bit of yield. And that brings you to kind of 4, right? Or let's just say, for example, you have $1,000 and you want to be a millionaire. And you're like, hey, man, it's the only $1,000 I'll ever have. Well, and you don't have, you work paycheck to paycheck and you don't have the ability to add another $1,000, like I said earlier. The easiest way to have the amount of times you have to double your money to get to $1 million, add another $1,000. You don't have that opportunity. You're going to have to invest in some risky shit that, high risk, high reward, right? So you're not going to sit there and be like, let me invest in AT&T, right? Like AT&T, you're not going to take your $1,000 and get to $1 million, my guy. So you have to understand what game you're trying to play in. So 4th is, and the 4th and 5th are kind of interchangeable. I try to rank them in order. Like objective is obviously number 1. 2, time horizon, because, that really helps understand. 3 is really just like, hey man, how comfortable, what kind of gut tolerances do you have for things going up and down? 4 is really how active or passive do you want to be within this investment? Say you're the kind of guy that's just like, hey man, I love going fishing on the weekends. I don't want to think about the stock market. I don't want to do any research. Jim Cramer, who? I don't want to be on Squawk. I don't want to be watching Squawk Box. Matt, I don't even be watching you right now. But here I am because I'm struggling. And you talk about finance, so that's why I'm here. Or you could be like, I don't want to be listening to Matt on Palantir Weekly. He smells. He looks like he smells. He hasn't shaved in years. Why am I listening to this guy? That could be the thought that you have. And so it's like, well, you want to be very hands-off, very passive. Index funds, man, S&P 500, CDs, stuff like that. Set up a CD ladder where you might have to talk about it once every, couple of years. I'm a firm believer that interest rates are going to be a little bit higher for longer than I think people think. And so CDs, if you're really worried about things going down, I'm not a big advocate for it, but if it's something where you're trying to save for a house in a year or two, probably not a bad decision, right? Versus trying your luck at the stock market. Who the hell knows, especially if you're not a very good stock picker, right? It could go down 100%, it could lose all of it. Versus somebody that, let's just say some people they don't like the literally magic or the fakeness or the inherent just non-visibility transparency associated with the stock market. They like real estate. They like being able to put elbow grease into things. Start a business, do real estate, flips, right? But somebody like myself who likes a little bit more passive sort of income, doesn't want to be, plunging toilets and stuff like that, the real estate thing kind of scares you a little bit, right? Where you're like, I already have a 9 to 5. Do I need a weekend job? Not really, right? So you kind of have to think, like, do I have a property manager? Like, what exactly am I signing up for? Is it how many hours a week is it? That sort of thing. But if you're somebody that's a handyman or like a carpenter, plumber, electrician, and you're like, dude, that's what I'm used to, man. I'm used to getting my hands dirty. I'm used to, being a tradesman, which we need more of in this country, by the way. Then the real estate thing, man, that's up your alley, right? And like you could be doing something like, you know what I mean? So like you have to think like I'm going to be very active in my investments, where I have 10 hours a day. Like I'm handicapped and I don't have the ability to get a job. But what I can do is act in the stock market and do, 10 hours a day of research, be a day trader. Me, I tried my stuff at day trading. I failed miserably. It's like, hey, Matt, surprise meeting. It's 9:30 in the morning. I'm like, shit, I got to go to this meeting. I'm watching this thing and it's going down, 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 down. I'm trying to, like, you know what I mean? Like you can't day trade when you're sitting in the 9:30 weekly meeting that you're talking about on Mondays. No bueno, my guy. So you have to realize what game you're in and understand that. And the fifth, which I think is extremely important. So it's not fifth due to lack of importance. It's how much capital you got to add. And this kind of goes back to the earlier question where it's like, your great aunt Susan passed away. My condolences, but here's $1,000. And you're sitting there paycheck to paycheck. And you're like, dude, I need to get out of this. The only way I can do it is if I go and I make $1 million. That's the only way I can be financially secure for myself. But I live paycheck to paycheck. The only thing I has is $1,000. Then you, like I said, you can't invest in an AT&T. You're not going to get anywhere. You have to find something like a Palantir or a Rocket Lab or something like that, and I'm diversify it too, right? Pick a few great companies that you do a little bit of research on. But that's the thing. That requires time. That requires effort. You can't just be like, hey, I heard Billy down the street likes Skechers stock and be like, let me invest in Skechers stock. You're going to go bankrupt. You can't invest that way. So you really have to understand, like, through that range of things, go through those 5 things: your objective, your time horizon, your risk tolerance, and how active you want to be in your investments, or passive. Maybe you don't want to do it at all. I get it. I've been there. And how much money are you going to add, right? Because then you can start to understand, man, I'm saving 30 grand a year, right? They could say, well, I want to get to $1 million. I'm saving 30 grand a year. If I do nothing in 30 years, I'll pretty much have it. Even if I make only like 1 or 2% a year. Huh. You're like, so why am I getting so risky if I just need $1 million, right? Granted, there's inflation and stuff like that. But keep in mind, it's like, well, okay. So for me, it's more of along the lines of I just need to keep it and keep doing what I'm doing. But if like you're sitting there and be like, all I can do is save $1,000, I need to get to $1 million. I'm okay if I either keep working for the rest of my life or get to the life that I want to live with $1 million. Then you're like, hey, I need to try to get a 30% return a year. Like I need to do something drastic to get to where I want to go. So let's do it. And you might sit there and be like, well, I don't really like the stock market. I don't like that lack of transparency. I don't get why sometimes the price to earnings ratio is at 15 and sometimes at 18. It doesn't make sense. It's made up. I get it, right? It's understandable. It's all about trust. It's all about where you think things are going. It's the ebbs and flows of the market, right? Maybe you don't want to rely on the ebbs and flows of the market. Maybe you want to rely more on your elbow grease to put $100,000 into this house and make it look better because you're a carpenter. You do it. You do contracting for a side business, and you're like, this house is in a $500,000 neighborhood. I could buy it for 300, put 50 grand into it and make it a $500,000 house, either live in it or refinance it. Like maybe you understand that. Maybe that's where your head is at. It's personal finance. You have to do what works for you. So hopefully that helped. I saw some people come in and out, and I really hope that helped them in any sort of shape or form. Delaying fund speeds. Yeah, piano away on a laptop, dimly lit room. Yeah, requires sacrifice. I think I answered this earlier, but I am I'm 31, going on 32. So you were making 6 figs. I wasn't. My salary was not above 6. Yeah, Becky Quick, thank you. I was not, but quickly thereafter I was. Can you talk about how you prioritize your investments? Nate, apologies. I'm like way behind, almost an hour behind. So I'm hopefully getting a little bit faster at these. But to me, the 401k is the most necessary thing. So I get a 7% match with my company, which is fortunate. So I'm glad that I get that. So that 7% match, that's the most important thing to me. 7% plus 7%, that gets you to 14%. I'm like, if I just need to retire off of that, I'm good. So if I need to work the entire time, I can. But I forget what the total number is. Let me pull up my spreadsheet here. Something pretty ridiculous. It's like 70% of my income. Sorry, 7% of my money is outside of my retirement accounts. Sorry, let it load here real quick. So my 401k is about 12%. I have like a retirement plan by the company. It's another 10%. And my Roth, which is 7%. So it's like 25%. So over 70% is in things that I can tangibly touch. And that's on purpose. So I could do way more contributions to a 401k, but I'm like, if I can't touch that until I'm saying that, people are like, oh, the rule is 72T. It's like, all right, my guy. So I'm going to retire at 50. They're going to allow me to take out, I don't know, 10 grand a year. It's like, what if I want to, instead of wait and get my 10 grand a year, I want to take that money, invest in a real estate property I can make cash flow today. Like, I get it. Like, I get the tax deferment aspect of things. I get that. But at the end of the day. So anyway, 401k is the most important. And then I used to do a lot more Roth and traditional IRA sort of investments. And first and foremost, I do a Roth 401k, but I've since kind of transitioned it to a Roth and pre-tax 401k, so more of like a traditional. And that's because I'm starting to get into a tax bracket where I'm like, that's a lot of taxes. So hopefully get a little bit of drip at the end of the year from that, or at least offset some of the capital gains and stuff that I get, or dividends that I get. And then the Roth, I used to contribute way more, and I've kind of just been like, and with all the other investments I'm doing, I've kind of pulled back on that a little bit. I've been trying to max out my traditional. Like I said, I used to do the Roth only. Now, because of taxes, I'm only really starting to focus on the traditional. I used to do the rollover at the end of the year, which was the Roth conversion. Some call it the backdoor IRA. Don't say that. If you're calling Fidelity or Vanguard, say, I want to do the backdoor. Call it a Roth conversion. Because otherwise they may be like, what's a backdoor? I don't know. That's a slang term, right? That's what you and I would call it. It's not what they would call it at Vanguard or Fidelity. So keep that in your pocket. I used to do the Roth conversion, which was invest $6,000 in traditional and then convert it over in a couple of months to the Roth, so you can bypass the income limits, because yes, I was hitting income limits for the Roth, but if you don't have to worry about that, you make under 100 grand, just invest in the Roth IRA. The thing that's nice about the Roth is because you can pull out your contributions, no problem. You can't pull out the gains, but the contributions you can pull out no problem. And so pretty cool. So like I said, I don't really prioritize that anymore, but I definitely prioritize the 7% every month that goes into my Roth / traditional 401k. And I try to do 50-50 on that. And keep in mind, any employer match is always going to be pre-tax, by the way. So you're always going to have to pay taxes regardless. Even if you do a Roth 401k and your corporate matches you, you're still going to end up paying taxes because they contribute pre-tax. Then I would say, man, it used to be kind of like dividend stocks. But more recently, it's like I try to match 50-50 probably between SPY and my speculative positions. I go through waves of what I'm looking at. So what I'll end up doing is like focusing on like an Amazon Google position, like I was when they were in the high 80s, low 90s. Now that they kind of retraced in price to the positive side, I haven't really been adding to Amazon and Google as of late. But I might be like, do some quick looks and be like, wow, Rocket Lab's only 2%, let's just say. I want to get it to 3. Why is it not 3? Right? That's a 50x potential return. I could stand losing 3% of my entire portfolio, but if it goes from a 3% all the way to 50%, that'd be awesome, because then I could diversify that into the S&P 500, right? Because it's grown so fast and the potential's there, right? So that's kind of how I evaluate it. Same thing with like Palantir. It's like, well, my Palantir position's like, I don't know, 30 grand. It's not even in the top 10 positions within the portfolio, if you look at it that way, in terms of total value. Capital contributions, I'd say it's probably in the top 10, but it's down 30% or so. So if you look at it that way, you're like, huh. But then you realize it's like, well, Palantir is still, I don't want to say speculative anymore, but it used to be, 2 years ago, it was kind of like, well, is this thing actually to turn around or what? Rocket Lab is still that sort of sense. Like they could still go belly up, things can happen. You can have multiple failed launches, and next thing you know, you're burning capital and not doing too hot. But so far, they've had small launch vehicle that's done really well, launched 35 times and done extremely well. So I'm pretty confident they'll be able to do the same with their medium launch vehicle, which we'll see in the next year or so. Sorry, but that's kind of where I've gotten to now, is kind of looking at how big of a position it is. Do I think it should be bigger? Do I think it should be smaller? Do I think I can continue to add to it? And it's like a lot of these things like Caterpillar, I'm like, Caterpillar's great, but I'm like, do I think Caterpillar is going to double in value over the next 10 years? I don't know. The S&P might, though. And I'm like, it's probably better if I just invest in the S&P. So I sold out of it, right? It was like 220 or something, and I sold out of it, put that money into the S&P. And then same thing with like Altria Group. Altria Group, I had made a pretty good return because of all the dividends that I reinvested in throughout the years. And so I made like an okay return. It wasn't like a barn burning return. It was definitely positive though. And I was like, is Altria Group going to double? Maybe, if it starts to get evaluated appropriately and it kind of gets out of the slump that it's in. But I was like, I don't think it's going to go to 100. It might go to 70. So it would really only be from where it is today, probably like a 50% return from today. So I was like, in 10 years, it's probably better if I invest in the S&P 500. So I sold out of that. Same thing with Exxon. It got to the hundreds or like 90s. I was like, do I think Exxon's going to go to 200? Probably not. So I was like, you know what? Let me take some of my Exxon and sell it and put some into Shell and put it into, I was like, do I think Shell's going to double? It's like Shell's undervalued right here, and they're doing a really good job on the transition of things, and they make a crap ton of cash. So I was like, Shell, I still think has some running room. So I'm going to keep that. So that's kind of what I do, and look at the portfolio and I just try to understand, is like, should I just get rid of that position? And I'm getting that way with Pepsi. Like I've made a very good amount of money on Pepsi. I think my shares are $120 cost basis or something like that. Or maybe that's my J&J. I don't really remember. But I'm up a pretty significant portion on my Pepsi. And I'm like sitting there and I'm like, is Pepsi going to double from here in the next 10 years? But that dividend's really nice, right? Like I get like $250 a quarter in dividends from Pepsi. And I'm like, but at this point, I'm making over 500, close to $600 a quarter from SPY. So I'm like, oh, if I put that 30, 40 grand of Pepsi into the SPY, like I could get that 600 a quarter up to like 800 a quarter, or like 750 a quarter in SPY. And it's like, what's the real benefit, How do you think they could Palantir? How do you think they could improve with getting management of clients to welcome Palantir and come into their business to help them with their issues, especially for smaller size corporations? It's difficult because it's basically admitting that the majority of what your internal IT department has been doing to try to make digitalization and efficiencies work is not working. And to a lot of CTOs, transformation officers or technology officers, that's going to be very difficult. It's going to be very, very difficult. So anyway, I don't know. I really don't have an idea other than just continuing to watch the clientele that Palantir deals with. And I think it's eventually going to get to the point where it's much easier and easier. But I think the thing that's going to eventually be the driver is, once it gets powerful enough and Palantir for Builders and the individual community gets better at it, then it's going to be something that hopefully becomes second nature. And the certificates that they offer, I think, will really well. Midwest cannabis, man, invented plastics. I've seen the Revolto, man, not in person, but the commercial, and it looks sick. And I'm really looking for Stradman is somebody that I follow on YouTube, and I think he's gonna get one. I'm looking forward to it. Yeah, dude, gas is going to zero. Lambo in 2030. I'm with you guys, man. I talked about that. Until we're all dead. There you go. The sun don't shine all the time, and the wind don't blow all the time. Hey, man. 99 Jimmy, man. Thank you. Yeah, I like the glass too. It has my name on it. My sister bought it for me. And when my dad passed away in October of 2021, I got his. So his has, it's the same. So I'm a Farley. He's a Farley, obviously. And his says since 1955. So I try not to use that one because if this one breaks, I'm not going to be that upset. And it's not that I couldn't get another one, right? But if his breaks, those are his, right? And I would feel bad if those broke. So I try to use mine instead. Yeah, man, I try to be balanced about all oil and gas and the transition. Like, trust me, it's here. And I think the thing that bothers people and bothers me is that people view it from a very American standpoint, and they view it as like, you have all these billionaires. This is the thing. You have all these billionaires that have done really, really well at making oil and gas. What's really simple to do is transition to something completely different. And that's growing really fast, so you can get a market share ownership in that and do really well. And what is that going to do? It's going to make more billionaires. And so you have these people that are power hungry that are maybe don't have a share in the oil market, but they want to share in energy. So they're all about it. One, it's better for the environment. Let's just be whole and honest about it. But two, it creates opportunity. And with opportunity, it creates opportunity for more money and everything of the like. And so I think it's just an opportunity for folks to really say, you know what, it's time to shake up the old hat and come up with a new world order that's looking at the future and is more social and sustainable and environmental friendly. And I think with that things become more regulated in that respect. But I think at the end of the day, it's always going to be spun in a very positive light. And because a lot of the times these same people that are trying to control people's minds are the ones that own the media companies in which they're trying to do it. So like, and I think that I had this conversation on Palantir Weekly quite a bit. And it's like, the reason why everybody was giving Elon crap for owning Twitter is because now you have another billionaire that has a media company that has the ability to, one, unearth all the bullshit that Twitter was hiding throughout the years. And then two, no longer do they have somebody that can be at the whims of the US government or whatever to hide things like they were in the past. And so that's going to lead a lot of, I guess, sheepish mind control of the sheep out in the open and allow somebody else to lead a conservative view now, which I think Elon leans more conservative than I'd say most like CNBC and stuff of the like. And so I think that's why it was a problem with CNBC and stuff like that. So that's just my opinion, though. So maybe it's a very political view, but don't want to get in trouble by that. Callum Patrol, I've heard of it. I don't have any thoughts because I honestly don't have too much research. If you're curious how you're reaching people, at least for me, I caught the stream because you posted it on Twitter. Very good. Appreciate that. And I feel like a lot of my like audience, my YouTube audience, a lot of the subscribers comes from a lot of the Fidelity videos that I've made over the years. So I get like sometimes hundreds of subscribers from those videos. And then a lot of times I'm not really talking about Fidelity. I'm talking about, my stuff. And so it doesn't end up, coming across. So I'll end up having a lot of unsubs because of that. Because it's like, man, you mean to tell me this guy doesn't talk about just Fidelity? Unsub, right? And I get it. Like, this is the way capitalism works. It's how YouTube works. And so I get it. So, but anyway, Twitter is a new following, specifically from like the Palantir, Rocket Lab, and people that are more in line with what I do on a day-to-day basis, rather than like the Fidelities of the world. So, Fidelity viewer subscribers of the world. So, hopefully that kind of helps. Nvidia is so calm and come off. So, one of the things that I hope to do a little bit better is I have this internal, how do I say this? I've had a conversation with some folks in the past because like I've tried creating a few businesses and they haven't done well. Like I tried making like a restaurant app and that didn't do well. And with that, like I had this conversation with somebody and I remember having this like distinct conversation. I was like, I feel like my inner monologue is something that a lot of people would agree with, but my fear is, and I guess it's like my internal anxiety and stuff like that, where I'm afraid I'm going to come off too strong, too much like an asshole, and I'm going to lose people. And at the same time, it's like, I feel like while I would love to be more like the Twitter version of me, I feel like when I speak, I'm just not there yet. Like having a face-to-face conversation, like I feel like with my friends and stuff like that, I can be honest and that savageness a little bit to an extent. But I feel like I'm like, I feel like I try to be too professional and too polished. But at the end of the day, like sometimes I think the bluntness like Chris Patel has would be better suited for me a little bit. So I don't know. I struggle between that a little bit. And sometimes I get that where, I'll kind of come out and do the clickbait and kind of tell people how it is. But I think you're right. I think the thing that bothers me a little bit the most is like I come off too polished to an extent, and too kind. And because of that, I try to over explain things and I need to be more direct a little bit. Matty, phenomenal day trader. Thanks, Michael. You're the man. You used to reveal the total amount in your portfolio. How come you stopped? Because it got to a point where I think people were really following me because they were like, and this is what I didn't want. And it was nice to an extent. Like, I felt like people were following me because I was like, hey, posting, getting close to 2 commas in my name, like next to my name, like that's really cool. But at the end of the day, to me, the value of what's coming out of my mouth is more important than somebody showing up for, let's just say, having 7 figures next to my name. The thing that I was realizing I was trying to do was get to the high 6-figure, low 7-figure mark to lure people in so that they would actually listen to me. When in reality, the value of the message is what I'm actually trying to say. And so I felt like I don't want to say tricking people, but it was like I was not creating a good channel culture by trying to specifically be like, hey, I'm a fucking millionaire by 31, right? Like that wasn't the right culture that I was trying to convey to an audience. What I was trying to say was at this point was like, hey, I got to that place, check the box, right? I woke up that day. I didn't feel any different. What I realized was I was still mentally broke in terms of like where I think I want to go to and where I was. Like the difference between having a couple $100,000 and let's just say 7 figures, I was like, okay, still no Lambo, right? Like I was like, still no Lambo, still no massive mansion. Like when Lambo, when big mansion, right? So it was like, okay, that didn't really matter. So the thought process is like, what really matters is what comes out of my mouth and my experience and helping people along that journey. And the only reason why I felt like some of these people were following me was because, hey, Matt's got a big portfolio. Sometimes he talks about hype stocks. It's like, dude, like, so I felt like a lot of the people that were following were losing the forest through the trees and they couldn't see the forest through the trees, I guess. And they were really trying to like nitpick about being like, no, this Matt said Wish was going to moon. And so it's like, dude, like Wish was like at one point, I guess total amount invested, like 4% of the portfolio. And so since it's basically gone to zero, like I'm not really hurting, but here you are investing 35% of your wealth in it and you're hurting really bad and you're upset at me. And it's like, dude, I never said put all your money into Wish. Like I said, hey, I have a portfolio of positions and Wish is a part of it. And it could be something does well. And I thought it would. And unfortunately, the CEO just kind of like bamboozled people. And I didn't realize how much of a financial engineering machine it was. And so, unfortunately, caught on the wrong side of that one. But, and then I think you have people about Palantir and Rocket Lab, and they're just like so concentrated on those things. And it's like, dude, like to an extent, they only want to selectively hear what's kind of coming out of my mouth and not hear the whole thing. And so they're kind of going through this like process of, what am I trying to say specifically, is like they're trying to go through this process of validation of what they want to hear and be like, oh, well, this guy's got $1 million fucking bucks. Like, I'm just going to listen to him. And it's like, dude, at the end of the day, it's like, it's personal finance, right? So you have to kind of do what's right for you. Just because I like to, burn candles and put hot candle wax on my legs because I like to feel the burn. Just because I have $1 million, are you going to do that? Like, it doesn't make any sense, right? So you have to kind of realize like what works for you, what doesn't. And because I was sharing the number, like I realized like people were more concerned about it than I was. And then when I woke up and I saw the two commas in my, like next to my name, I was just like, don't feel any different. Still have a long way to go. It's a lifelong journey. And to me, the messages that I was kind of speaking were kind of what it was. And so, to an extent, I still bring it out from time to time because I think it's kind of inevitable to understand at this point that because of how much I save and how much I invest, like what the portfolio size is. But you have to think like 7 figures. That's a lot like of range, right? Like you have to think between 5 figures and between the second that you hit 6 figures and 7 figures, like that number, you have to think there are 10 of those going from 7 figures to 8 figures, right? So it's like, it's just another step in the ladder. And at the end of the day, the more you realize, the further along you go, the more you realize you don't know anything. And so with that, I'm just trying my best to help in any sort of way. And the thing that I did realize was probably the most beneficial piece of this, and then I'll kind of move on to the next question, is like, in order to get to where you want to go, in order to get to where you think you need to be financially, your mind has to get there first. And so like, if I wasn't somebody that was saving 30% of my income and investing as much as I could, like I made a lot of mistakes along the way, but because of my high savings rate, because I was so diligent, so focused, and I was mentally right up here, the numbers were able to catch up regardless. Versus like if I wasn't right mentally prepared for it and wasn't thinking about things appropriately, and I was sitting there being like, I'm going to invest this $1,000 and become a millionaire tomorrow, that I probably wouldn't have gotten anywhere, right? Like if I just went to the club every weekend and bought bottles and been like, man, I got $1,000 in my Robinhood account, it's going to turn into $1 million one day. And I wasn't sitting there being like, okay, I saved $3,000 this month and invested it. How can I save $4,000 next month or $5,000 or whatever? There's been months where I've invested 5 figures, right? And there's been things that I've invested, the biggest purchase I probably did at one time was probably like $25,000 at once. I'm not including the rental property recently, but things like that where it's just like, you don't build up to that day one, right? Like that's things where you have to think like, I used to think a $100 investment was a lot of money. And I thought a $500 investment was a lot of money. And $1,000 investment was a lot of money. And it got to the point where I was like, $5,000, a lot of money. And then like, not to say like $100 is still a lot of money, but you have to realize you have to train yourself in between all these different things. And you have to prepare yourself mentally. Like you can't just go from 0 to $1 million and expect to do well. A really good quote by Jim Rohn is, somebody hands you $1 million, best you become a millionaire quickly. So you get to keep the money. What that basically means is like, if you're not right in the mind and somebody gives you $1 million, you're just gonna be like, let me go buy a Lambo. Let me go buy a house. Let me go buy, and next thing you know, the $1 million is gone. You see the story about Shaq And he's like, he got $1 million sign-on bonus, and it was gone within a couple days because he bought himself a Mercedes, he bought his dad a Mercedes, his mom a Mercedes. He bought 3 of the same Mercedes, and he bought a mom a house, like all that stuff. And next thing you know, like he owed taxes. The taxes ate 350 grand of it, and he owed money on that $1 million that he got. So it's like you have to realize, like, in order for things to kind of catch up in the bank account, you have to be right up here. And that's what I'm trying to teach. The things that get you right up here, not that, hey, this kid at 31 years old, like next thing you know, people are going to be like, ooh, what stock did you pick to get to that? Like there's got to be some stock. There's got to be some crazy methodology that you had to get to where you got to by 31 years old. And then, that what really upset me? I didn't do it by 30 because that was my goal. But at the end of the day, shit happens, and you got to take things and, do well with them and do the best that you can. But the thing that I was fearing most was people were more concentrating on the number than the things that I was saying. And they were more so concerned about, and the thing that the culture that I was seeing come out of the channel was, wow, Matt, what stock? Like, is that Palantir that's going to get you to fucking 10 million? Is that Rocket Lab that's going to get you to 10 million? Like, what's that stock? What's that one stock? And it's like, it's not going to be one stock. It's going to be a combination of multiple stocks. It's going to be the combination of me continuing to save diligently every single month. It's going to be a combination of all these things that I've been training myself to do for the past 10 years that people aren't necessarily concentrating on because they just think they're going to turn $1,000 into $10 million and never have to work a day in their lives. And that's so rare and few and far between. So, and I wish everybody the best of luck if they think that's going to be them, but it's likely not going to be. So glad you're still here. Glad you were able to hear from that. Yeah, exactly. Earning income from hard work and saving it, and on a hustle, way more of a sure thing than investments hitting the moon. And so that's kind of what I realized. I was like, what's kind of guaranteed? 8 to 10% returns. What I could do is spend that hour, go get $1,000, put it in the market, get that 8 to 10% returns, than me trying to make $1,000 in a couple hours in the stock market. Very difficult. Very difficult. 24 years old, current 135K, investing mostly in SP and Canadian called VDY, taking more risks in your long-term investing portfolio. That's really up to you, man. And I'm hoping that you were here when I was kind of talking about those 5 things that you need to be looking at, right? Like, it's all personal finance. So it depends on how much money you're adding every single month to the portfolio. Depends on how much risk you want to take on. Depends how active and passive you want to be in your investments. Depends how much you're adding to your portfolio. Depends on what your objectives are. But I think 135 grand in 24 that's phenomenal, man. I think that's probably ahead of where I was. I think I didn't really get my feet on the ground until 23, 24, and I probably had like 50K by the end of it. So just keep on keeping on. Yeah. Midwest Cannabis said it right, man. Sometimes a good financial, that's the key word, is good. Sometimes most financial advisors are like, well, let's get you in these ETFs, and we're going to get you in these things that are front end loaded at 5%, and yada yada. It's like, if you didn't understand a lot of that, then you're going to leave money on the table. And I had one friend, she asked me, she's like, are these good investments? And I was like, you're eating 2.5% a year and just fees. And I was laughing, and she was getting very upset at me. And I was just like, dude, like, I don't know what you want me to say. Like, I've asked you to like let me help you in any sort of way. And luckily, I think she canceled that lady that she was doing as a financial advisor, but she was eating like $500 a year minimum. And then it was like on top of the funds expense ratios coupled with the 1% fee, it was like 2.5% off of like a $50,000 investment. I'm like, dude, like, what are you doing? I was like, don't do this. I was like, just invest in like the S&P 500 or something like that. She got very upset with me. And yeah, anyway. What's your setup looking like? Not sure what you mean. Yeah. Hey, you're doing really well, Brandon. You gotta do it. I'm not sure what this means. What's your setup looking like? Yeah, dude. Farley's gotta love it. Where did I mostly grow up? I grew up mostly in Pennsylvania. And then I moved here. Well, I grew up entirely in Pennsylvania, and I moved to Texas in 2013 for a job. I did an internship here in 2012. And I've been in Texas majority of the time ever since. I did a year in Trinidad and Tobago for work as well. Don't know what AEVA is. Sofi. I did a little bit of research in the past, but not recently. I think that's something I might look into, specifically now that they're kind of getting to the point where they're turning the corner, getting closer to profitability. Coin, I wanted to particularly look at Coin a few months ago when everyone was really down and out about crypto. And I'm a pretty long-term believer in the entire crypto market. Do I agree that all cryptos are good? No, there's like 18 to 19,000 of them that are at least known by coinmarketcap.com. And I'd say 18,995 of them are garbage. And so with that, that means that there's probably 5 or 6 that are actually decent and will get better with time. But that being said, I think Coin is likely to do well in the long term, but I haven't really looked at the financials and the stock price at the moment. I know it kind of went on a pretty good run over the past few months. So I personally just need to do a little bit more due diligence before I say I've done any research. So for now, I'd just say, no, I haven't done as much research as I'd want. Yeah, listen to Michael about this one. I don't know much about SoFi personally. So Citi has taken on a lot of risk and risk management and credit management risk, if that's the case. And so if that's the culture and SoFi is taking that on, that's something to be very concerned of in the future. And especially if you're taking on a lot of culture from a different company, that's something to be very considerate of, because you're going to have a very big company sort of culture coming into a small company might hinder growth, right? Which you have to worry about, certain things and move with caution in a bigger company versus a smaller company. You have to be more innovative and quick to turn around things because, you're trying to move the dial, you're trying to make a company grow, versus some of these big companies, they're just trying to stay alive most of the time. And not mess anything up, right? Keep the kind of gravy train going. It goes from some of these bigger companies has gone from innovation and what works to basically just like the status quo, right? And just trying to keep things going. That's what you see at like AT&T. You see a lot of these long-term companies that are like, we care most about our shareholders. It's like, I get it. You want to make sure your shareholders are aligned with you. But at the end of the day, it's not about necessarily focusing on dollars and cents. It's like, you have to focus on a purpose that does well, which in turn comes with dollars and cents, which is why Apple's always done relatively well. Apple's had its peaks and troughs of, like, say, close to bankruptcy, but at the end of the day, they're a very purpose-led organization, which led them to be one of the most valuable brands in the world today, right? You think if they just cared about the dollars and cents of things, that they would be as great of a brand value as you would see. Like, you'd have people having Apple stickers and praising Steve Jobs. Like, no, like, you have people that love Doritos, but you don't see them getting tattooed on them or like living and dying by the CEO of Pepsi, right? So the purpose-led organizations is something that truly is fascinating to me, where it's gone from like we have to meet our numbers sort of thing to, if you focus strictly on the dollars and cents, that means you're going to focus too much on efficiency. And eventually in the long term, your company's going to die, because what's not efficient is innovation. Innovation is very inefficient. You try, you fail, you try, you fail, you try, you fail, try, succeed a little bit. In 10 years, you fail. You have these little things and that's why Google has done relatively well, because they continue to reinvent themselves. They didn't just have the search engine. They had the search engine, and then they added Google Maps, and then they added Gmail, and then they added all these other things that continue to add on to the plethora of products that they continue to have that ended up being this great moat of opportunity that we now know as Google and Alphabet. But you have to try different things that eventually does well. That's why Google invested 7% or owns 7% of SpaceX. That's why Google has all these other conglomerate of things like Baird and some of the things that they're trying in AI. And That's why Amazon does well, because they try things like AI, they try the cloud services, they try the e-commerce. They went from selling books to selling other things, right? That's that try, fail, innovate technology sort of mentality that I feel like a lot of these shareholder driven organizations these days that are like, no, we need to give money back. We need to buybacks. It's like that money could be used to, like, you think about it, instead of giving $20 billion back to the shareholders, I get it. Like it's $20 billion, but it kind of gets you in this chicken and egg situation. It's like, if you make a 20% return on your invested capital, that's $4 billion you just missed out on an annualized basis, right? Cool. Glad we're on the same page. The other thing is, the majority of the shareholders that you're talking about are institutional investors. Vanguard, BlackRock, State Street, PNC, all these massive conglomerates of companies, Berkshire Hathaway. Of course, they want buybacks, because at the end of the day, that means they have more and more control over the board seats that are allowed to design and direct these organizations. Nobody in their right mind is getting a massive ownership position like you or myself that is truly going to make a difference. It's like, well, I went from owning 0.0001% of the company to 0.000011% of the company. I'm really sitting rich. I'm the next Warren. It's like, no, that's not really how this goes. You have these organizations that are owned by State Street, Vanguard, BlackRock, and get to the point where it's like, yes, they're the ones that want the buybacks, because they want to go from owning 25% of the company to 30, to 35, to 40, to the point where they continue to buy more and more shares of the shareholder like myself, because we're trading on the open market or what have you. These companies are hoarding, and then they're buying back the float, and they're not relatively selling that float very easily, because they have all these ETFs and assets under management and yada yada yada. So I think that goes back to that chicken and egg sort of situation a little bit, where these purpose-led organizations are the ones that will continue to do well. And the reason why is because consumer interests change, the way that things do business change, efficiencies change. Like 6%, like we was talking about this with real estate the other day, 6% per real estate transaction. It's pretty interesting, right? But you think about it, it's like, you didn't used to have Zillow. You didn't used to have MLS things that would send you emails every time a new house would come up. You'd have to use a real estate agent because they actually knew what was going on. They were in charge of a neighborhood, and they would actually tell you what exactly is available for sale. Now you can just go on Zillow and find the house yourself, and now you contact a real estate agent and say, this is the house I want to look at. Like before, you used to have to be like, hey, I want a 3-bed, 2-bedroom house, 3-bed, 2-bath house, because my family's getting bigger, and they would have to literally find things that you couldn't find on the internet because there was no internet. So they warranted that 6%. Now things that the efficiencies have gotten so good in real estate, it's like, why are we charging 6% anymore? Doesn't make any sense. So it's things like that where you continue to have these things. And same thing with like Visa and MasterCard. It's like you used to have literally Visa and MasterCard be the only games in town of payment processing. So they used to charge 2.5%. And same with American Express. They charged 3.5%. It's like they were the only games in town. So of course, charge your 2.5%. Now it's like, should we really let them charge 2.5%? It's a lot of every transaction. It's billions a year. Like, does that make sense? I don't know, right? Like, should there be something like a Square, PayPal, these things that can help a little bit? Not to say PayPal is perfect, because that charges 3%, 3.5% sometimes. But just makes you think, like, things used to be impossible. Now they're not. The efficiencies have gotten better to the point where we need to question the things that, and so you need to continue to transition. And if something doesn't get better, whether it's the service or what have you, you're really going to sit there and be like, do we really need a Visa? Maybe we should. And that's what happened to American Express. Granted, American Express does really, really well. They have a lot of partnerships, offer a lot of perk, and they're still a bank at the end of the day, unlike Visa and MasterCard, which are kind of like just technology companies that transition or do the transactions. Amex is actually a bank. But at the end of the day, it's like Costco dropped Amex. Amex used to be the preferred partner of Costco and a few other companies, because they were like, Amex is the company. But it got to the point where it was like, Visa did just as good of a job and allowed the payment processing of only 2% or 2.5% versus the 3.5% that Amex was charging. So we're like, we literally can increase our margins. Let's just say a company's margins are only like 2%. And they're like, well, we could give this 1% of every transaction to Amex, or we could save that 1% if we switch to Visa. It's like, well, now all the transaction fees just got lifted by 1%, and your margins go up drastically from 2 to 3%. You're 50% you're increasing your margins by 50%, going from 2% to 3%. And that's a big deal when you're doing with hundreds of billions of dollars a transaction a year. It's a couple $1 billion worth. So anyway, just this is the thought. You're going to be dropshipping million by next Wednesday. I hear you, my guy. Someone's got to do it. It's not going to be me. Yeah, man, I think people just don't realize company culture is a huge piece of what makes people or companies successful. And I think that's one of the big things that Palantir does that a lot of people don't realize. Mm-hmm. Yeah, company leadership is a big thing, right? And I think a lot of people give crap to like the old CEO, or I don't know if he's still the founder or what, but like Jeff Bezos, like people gave him a lot of crap. Like, when are you going to make $1, Jeff? He's like, I'm more important about like just getting the infrastructure ready and the customer being number one and all those things. And same with Steve Jobs. Everyone's just like, when dividend, when buybacks. And Tim Cook has been able to, balance that relatively well. But in bad times, like you get companies in a bad place. Like Shell, for example, a couple of years ago, and this is kind of like an interesting conversation that I have internally a lot, is like Shell at one point got to the point where they're paying $15 billion a year in dividends. And it's like, once you kind of establish a dividend, you kind of are forced to pay it. And so what happens when oil price dries up like it did in 2020? It's like you're forced to cut the dividend. They cut the dividend 66%. And so they went from paying a $15 billion a year dividend to $5. It's like, well, they did the exact opposite thing that I would have done in 2021 and 2022, which like they raised it massively. And now it's back to the point where it's almost back to that $15 billion a year in dividends that they're paying. And to me, it was like you kind of gave yourself a way out of having to pay so much in dividends and been able to, say, invest something into, say, renewables or establish a business that could grow over time in a pretty quick succession. And it's like, I get that you want to reestablish dividend payments and stuff like that, but if you're able to invest in something that's an 8 to 10% return, and the next time you might have to invest money into it, it might be at 12 to 15% or 15 to 20%. It's like, I would much rather invest in that something that's going to be 8 to 10% return and save that $10 billion. Because you think about it, it's like that $10 billion a year that you're saving, it's going to make, let's say 24 months to 36 months it might take to get that thing online. It's going to be making 800 to $1 billion a year, 800 million to $1 billion a year in earnings from that return, right? Because 8 to 10% return for $10 billion. And it's like, cool. It's like, okay, so the next year you do the same. It's like, now you're making 1.6 to $2 billion a year off of that. And it's like, wow, like that would make some companies, right? Some companies would love to be at 1.6 to $2 billion a year in income, right? And here you are just giving it back to shareholders in the form of dividends and stuff of the like. It's like, I get it, but I don't, right? And you kind of have to think, it's like, at what point is it, like the reason why companies pay dividends is because they view it as more beneficial to pay the shareholders in terms of returns than reinvesting back into their business. And it's like, well, if you have these opportunities in transition businesses like a Shell and Exxon and some of these other companies that are trying to lead the transition, is it more prudent to invest that capital into these transitioning businesses that are growing at 20, 30, 40% rates? And it's like, if you cut the dividends slightly or the buybacks slightly and reinvest back in the business, like in the long term, if you're able to sustain 8 to 10% dividend growth, 8 to 10% EBITDA growth, or 8 to 10% return on invested capital by investing in that, in the short term, you might not be giving more dividends. In the short term, you might not be giving more buybacks. But in the long term, in say 10 years, you're going to be giving more buybacks and your company's going to be more stable. And so it's like, it leads to this chicken and egg sort of situation, which, are we appropriately monitoring and rewarding CEOs for what they're doing. Because a lot of times what ends up happening is the board, because this is the way capitalism works to an extent, is they'll say, we need EPS growth of X in order for you to get these shares that we're giving you as options. And unfortunately, those things only look 2 to 3 years out. So what's the easiest thing to do is try to buy back 6% or 10% of the float in order to kind of get that. So it's like, well, we're going to invest a little bit of capital. So we're going to get EBITDA growth of, say, 5%. So that 5%, and then if you buy back 10% of the float, we're going to get 15 to 20% EPS growth, which is kind of what I need in order to get those shares. It's like you're kind of incentivized to buy back the float rather than try to move the dial by reinvesting. Because unfortunately, sometimes when you try to reinvest, some things go well, some things don't. Then you have to kind of lead to the fact that it's like, are we actually to get the 8 to 10% return that we thought? So it kind of leads to this chicken or the egg situation. But it's like at the end of the day, if you're able to get that 8 to 10% return and keep that within the organization, that's just going to snowball on itself. So anyway, it kind of leads you to the point where it's like, are share buybacks and dividends and stuff of the like the best thing for an organization? And it kind of leads you to understand, like, once again, going back to your perspective about where you are in your investment cycle and what your objectives are, it's like you need AT&Ts of the world. I mean, you need some of these dividend paying companies of the world because you're a retiree and you just want to make sure that the longevity of your dividend portfolio lasts so you can keep paying your bills, supplement your income, what have you. But then you get to the point where you're in the world that you are today, where you're like, I could just put money into CDs, and that CD is going to pay me 5% a year, right? And that could be something that's more stable to you that in a world that we haven't been able to really be in for the past 15 years since 2008, when we killed the bond market and we destroyed, the interest rates with zero interest rate policies. So it just gives you a little thought process. And Kev, what's going on, man? It's late. I guess not so late for you because you're 2 hours behind. But yeah, I think I'm about to call it. Had some steady people, 20 people in here pretty regularly. Climbed up to 27, 28 people. As always, truly appreciate you guys. Really hope to continue to do these things more regularly. But it's a little bit difficult. I try to give a night a week to oh, no worries, Kev, you're the man. We chat all the time, so not a problem. But yeah, it's like I get so caught up sometimes with Palantir Weekly that I forget to address the audience themselves. And sometimes I feel like you guys get to only hear about Palantir and you don't get to hear about some of the other things that I have my mind on or that I'm doing with the portfolio, and I don't get to answer the questions. So as always, guys, I'm reachable on Twitter, YouTube, all that fancy stuff. So let me just top my Twitter and stuff on here. If you guys don't follow me, you have that opportunity, and more than happy to answer questions and DMs or tweets or what have you. But yeah, Mike, I need to come and visit. It's been a while. So, but you guys rock, and I appreciate you guys taking the time. And like I said, I'm going to try to make an effort to kind of come on here a little bit more because I feel like with things kind of happening 10 months ago with me kind of splitting up with Kyle and not really doing too much in terms of, hey, we even got my guy in here. Splitting up with Kyle, not doing as many of those kind of streams anymore. I don't get to answer the questions as much as I'd want to. Everything's very Palantir focused these days, which is a good thing. I'm a very, very bullish on that. But at the end of the day, it's, I do this YouTube thing to be able to chat with you guys a little bit more. And unfortunately, I've dropped that ball. So appreciate everybody. Hope to talk to you guys soon. And don't do anything I wouldn't do. Talk to you guys soon. And hopefully that 2.5 hours was good for y'all. It was fun. So have a good night.